welcome to the latest episode of the Resilient Investor Podcast. This episode, Sam, it's a bit different, isn't it?
It is indeed. We're titling this the Practical Investor Session, where I will be taking David through a series of questions about how to invest practically.
Yeah, kind of portfolio stuff, terms that people use, what should you go for in terms of kind of broking accounts, so all the kind of practical things that a kind of novice investor wants to really sort of get worked out before they start putting their money to work. But we have got an idea, and we'll finish with the investment idea at the end. Yeah?
Indeed, yeah.
We've got a listed venture capital fund, which I think is quite interesting. Anyway, start off, shoot. Come on, what's your first question?
First question I'm starting with, start broad. How much is enough? What percentage to save? How much to retire? If you're starting out investing, how much is enough? You know, what do we start with? What do we end with?
So the rough goal is, if you look at investment as a part of savings,
right?
And so there's two parts to savings. There's kind of cash savings, which the golden rule is you should usually have about 6 months cash or near cash
in your sock drawer.
In your sock drawer, very big sock drawer. But you should have about certainly 3 to 6 months cash that you can access easily.
Yeah.
That could be in a savings account,
yeah.
It could be in a instant access account, could even be in a kind of 6 month notice account or something. So usually that's like 3 to 6 months. And then you've got your long-term savings. And the golden principle is that you should probably, on average, be saving about 20% of your net income. And I know that's quite tough for a lot of people because they've got
per year.
Per year. Yeah. So, let's say you make, £10,000 a year, not very well paid, below the minimum wage. You should be looking to saving about £2,000 a year. Now, I know that's really difficult, particularly younger people, because they've got to save up. If they've got kids or family, that's
and
expensive.
And cost of living.
And accommodation, rent or mortgages, So I realise that varies. And honestly, as you get older, sometimes you tend to have a little bit more cash, So the irony is, although everybody says you should save 20% of your kind of net income after tax, quite often people save less when they're younger, paradoxically. And then when particularly the kids are a bit older, and they're in school and you bought your property, actually you quite often save more, So the irony is, there's a lot of studies that have shown that actually people start kind of accelerating their savings from kind of their mid-40s really, and then they go for a kind of growth spurt for savings where they quite often get above 20% from their mid-40s through to their kind of late 50s. So that's the rough and ready guide. How much do you need to retire is a separate question. With it varies, but there's some evidence to show that, and some studies have been done on this, but by and large, the evidence is you need about £25,000 a year for retirement income to have a reasonably comfortable lifestyle.
But that also depends on location of retirement, presumably.
Yeah, it does.
That's where you can.
Yeah, absolutely. And there's all sorts of variations around the thing. But if you sort of, in today's money, sort of look at about £25,000 a year for a single person, probably like $37,500 for a couple.
Yeah.
And then if you use that 25,000, bear in mind you get a state pension, by and large, and state pension, will be whatever it is in the future. So not all of that £25,000 a year if you're single has to come from your retirement pot. For argument's sake, let's say £15,000 a year has to come from your retirement pot.
Yeah.
You can then use another kind of rough and ready rule. So we've had the 20% rule, the £25,000 a year. And by the way, if you want a more comfortable lifestyle in retirement, it might well be higher.
Yes.
But let's just use 25. There's another rough and ready rule, which is called the 4% rule. And the 4% rule roughly says whatever amount of money you've accumulated at the end of your working life, you can usually take about 4% a year of that, either as income or capital drawdown. Now that it's not a perfect rule. It varies. You could, for instance, I know people, advisors who say you can get 4.5%, 5%, But I think 4% feels about right, because if nothing else, you can probably draw an income if you invest in shares, draw an income of 2.5% to 3.5% a year on its own, and then you can take a little bit of the capital out, but of course the capital's going up because shares go up over the long term. So 4% is about right. So just do the maths, So if you're aiming at £25,000 a year, and you've got a 4% rule, well, basically it's 20 times 25,000 quid a year, yeah? That's 25 times 25,000 quid a year, which on my maths works out about 650,000 quid in today's money.
Yeah.
So, and that goal moves around, but I mean, 500 to 750,000, pretty much the absolute minimum would probably be in today's money, 350. Yeah. Now, bear in mind, if you're, for instance, 30, you've probably got at least 30 years, if not 35 years, to save up that money. Yeah. And I remember I kept saying it's today's money.
Yeah.
So that's roughly, you need to basically save somewhere between 350 and 700,000 quid over the next, in your case, 35 years.
Better start tomorrow.
Yeah.
Moving on nicely, SIPP or ISA as a starting out, both have benefits.
Yeah, so let's just explain the acronyms. ISA is a savings allowance, individual savings allowance, and that's a tax-free tax-free money you put into the account, but you don't get any tax relief.
No.
Yeah. So whatever you have in the pot, in the ISA pot, is yours and it's not taxed. Okay, but you don't get any tax relief on the way in. A SIPP is a self-invested personal pension plan, and that does get tax relief, either at the basic rate, 20%, or the higher rate, 40%. So that means that the HMRC gives you money back. Yeah, so you get tax relief on the way in. But the problem is that you then have to pay tax on the way out. Yeah? So if you're earning an income, you basically have to pay income tax on that income when you retire. So they both have their advantages. One is an entirely tax-free lump sum. I keep saying lump sum. I suppose it is lump sum, really. You have a tax-free capital, but you never get any relief on the way in, and a pension you get relief on the way in, but you pay tax
on the way out.
I'm actually a great believer in ISAs.
Yeah.
Yeah. I think you should max out your ISA first. And then whatever you've got, because you can only put 20,000 quid a year into an ISA, and then you should basically put what remains in a pension. Some advisors much prefer focusing on a pension because you get the tax relief. Pensions are also a little bit more complicated in what you can and cannot do. Yeah. ISAs, they have their complications, but they're not as complicated.
ISAs are also...
You can do both, by the way. So it's not.
But you have access to an ISA. With a SIPP, you don't until.
Yes. So that and you raise.
For me, as a younger investor, thinking of closer time horizons and the need of capital.
Yes, that makes a lot more sense. Yeah, absolutely. Yeah.
I've got both, by the way, just for disclosure. I have a SIPP,
and you can do both. Yeah. And so there's nothing wrong with doing both. Yeah.
Actually, I would argue my SIPP is outperforming my ISAs by quite a considerable amount.
Yeah, absolutely. There is a downside to that flexibility point, Sam, which is that you can take the money out. Yeah, in an ISA.
You're taxed.
No. So you are more tempted in an ISA in emergencies or in kind of just life situations to draw on that ISA.
But is that not what your savings?
Yeah, I suppose so. But I suppose the point about the earlier question about how much do you need when you retire is you'll never get there if you keep drawing out. Yeah. So and arguably that's why a pension works, because a pension forces you to have that discipline. So, but you can of course draw a pension from 55 onwards, or that's changing. It's going to go up.
I know. By the time I get to 55,
it'll be 86 or something like that.
Yeah, upon death, you will receive your pension.
Upon death. Yeah.
Thank you, Rishi.
Yeah. Here, well done for working all these years. You're now dead, and we'll give you money. So that's the idea of pensions, that you are locking that money up for 25, 30 years. But personally, I think ISAs are much more flexible for most people.
Yeah. Agreed. Good. Moving on, slightly away from the savings and what have you, but similar things. Platform. We're looking at platforms, online platforms, popular platforms, fully paid for. What are the different options available?
Yeah, I'm assuming that most people go online. Yeah, I think that's probably the default option now, isn't it? Really. So default is online, and there are sort of two platform types that you can go for. There's the kind of what I call full service platform. Well, actually, there's three really. There's your wealth advisors, or IFAs, They tend to really only like dealing with people who've got anything between 100 and 500,000.
Yes.
Yeah. Because their fees and their economics, it doesn't really make a lot of sense for them, and they can be brilliant. So I, for instance, I use an outfit called Killick & Co. They're great. They don't really tend to like people much under $250,000, but you get free will writing with them. Quite good financial planning. Good service, which is worth quite a bit. But that's probably not ideal if you're younger and starting out on the road. So they're the kind of full service.
Yeah.
Next up, you have the kind of full service online platforms, and the three biggest ones really there are Hargreaves Lansdown, AJ Bell, and Interactive Investor. There are some other ones, but they're the three big guys in the market really.
Yeah.
And they're all good. I've used all of them in the past, and I can't really complain about any of them. I find Hargreaves Lansdown a tiny bit more expensive, but very good service.
Yeah.
I find Interactive Investor very good online product. Work for some things. They have a flat fee structure, which does help. I think AJ Bell have got great platform. They've got really good their own funds that you can run on the platform. They're all much. They're all pretty good, yeah. And they're just slightly different horses, different courses, really. So they're the kind of full service online options. And then you have the kind of lower cost, pure online options, because you can ring up a Hargreaves Lansdown and talk to someone on the telephone. You can ring up Interactive Investor and talk to someone on the telephone. You then have the kind of pure, really digital or internet only platforms. And I suppose the big ones there are Free Trade, Trading 212, eToro. I'd probably put IG in there, IG. I use IG for one of my ACEs, and they're really very good value for American equities. And all of these really are kind of online only platforms. They don't charge as much for running your share dealing or that kind of stuff. Free in some cases. They're not so. Free Trade's never. I mean, you can have a free account, but you do still, if you want to get most of the services.
There's a plus account which I pay, which is still a small amount. I have both Hargreaves and Free Trade. Started with Hargreaves, and my SIPP and one of my ISAs is with Hargreaves. But in the first couple of years of investing, when I was trading in and out more frequently than I do now, it does catch up with you the cost when you do an end of year analysis and realise the money spent on trades in and out. So it is important to be aware that kind of road returns. But I agree, Hargreaves is a very good full platform.
It's very good.
Free Trade was good for
Free Trade's good for absolutely
kind of satellite investing, as I called it, where I was picking and choosing stocks more freely.
So quite often you find with the free platforms, they're not really entirely free in truth, because the stuff you really want you actually have to pay for. But they are a lot cheaper and they're very effective. I would give an honorary mention, I said, just to IG, which normally do spread betting index kind of stuff, but they actually run IG Markets. They run a kind of stockbroking business online. And actually, I do a lot of my US investing through there because actually all the trades are free. And they don't charge you a platform fee. But for that, So that, and actually you can pretty much invest in everything. So IG is quite an interesting bet, But my advice probably is keep your costs low at the beginning by going for a kind of app-only product. And then as that lump sum grows, then think about moving up that kind of product scale.
Okay, and that covers off one of my questions I was going to have later, which was around the costs of investing. So I will jump to products themselves, funds or stocks, and within those funds, trusts or ETFs. So I know we've covered them in the past, but what's your snapshot?
So again, my advice generally is if you're starting out, I'd stick with funds first. I think funds are a better idea because there's, as we've discussed, there's a lot of kind of intricacies involved with picking individual company shares. And that's not to say you can't do it, and you absolutely should do it. And if you've run what we call a core satellite approach, core, which is your main lump of money, and then you play with your satellite portfolio. You could maybe try some individual stocks in your satellite portfolio, but keep your funds in the core portfolio. I think funds are a good idea, and then really you face the choice. I mean, particularly if you're an online platform, it's really between listed funds, which is exchange-traded funds, ETFs, and investment trusts, which are actively managed. And different horses, different courses, really. ETFs are cheaper, very effective at giving you diversified exposure. So if you want to buy, say, US equities, you'd buy, say, a S&P 500 tracker. Investment trusts, which are actively managed, they have a fund manager who picks the stocks for you and puts them in the fund. Again, you could buy a US equities fund, and there are quite a few of them out there, and they do a really good job. They tend to be a little more, how can I put it, more idiosyncratic. They might go after particular types of stocks. They might go after what we call growth stocks, which are slightly riskier, higher growth stocks, or they might go after value stocks, which are cheaper stocks, yeah? So active fund managers, you can do that with ETFs, but active fund managers tend to be a little bit more like that. And again, it's like ISAs and SIPPs. It's not an either or. You can use both. It's absolutely fine to use investment trusts for some things and ETFs for other things. And where I tend to find it is more specialist, more complicated stuff. Yeah, people tend to go investment trusts. Where it's more kind of generic, mainstream, big markets that everybody's heard of, they'll go ETFs.
Good answer. And how to allocate? How to allocate between classes?
Yeah.
So when looking at your portfolio.
Yeah. So this is a question a lot of people get slightly hung up on. They go, so I've got my £10,000. I want to invest it in stuff, and which funds do I put it in? Do I have it only US or UK? And one of the ways to do, if you want to make life really simple, is you could, for instance, and that's just equities. You could have bonds as well. Yeah. And then you could have commodities, which are alternatives, yeah? So the three main categories are equities, bonds, and alternatives.
Mm-hmm.
And the mix completely varies on your risk tolerance, your age, your interest, your enthusiasms, and there's no one size fits all. But, for instance, a standard idea, which is the 60-40 idea, 60% equities, 40% bonds, gives you some diversification. Very traditional idea, works for lots of people, doesn't work all the time, hasn't worked in the last year very well, but has worked very well over the long term. Other people say if you're young, just go for 100% equities, yeah? And if, for instance, you go for 100% equities, you could make your life really simple, and you could just go for a fund that tracks something like an index which tracks world equities, yeah, which is something like MSCI World or S&P Global or FTSE All World, yeah? And they've got all of the major markets in one fund, yeah? And there are actively managed versions of that as well, so Alliance Trust, Witten, and Investment Trust now. And then some people just go, no, I want 100% equities, but I want 50% America, 50% with other funds around the world, yeah? So, and that's actually a very important last point, which is if you look at, for instance, something like the MSCI World Index, which is all the world's major equities, or another version which is called the ACWI, which is all the world's equities plus emerging markets. Actually, you'll find that American equities, stocks and shares, are the biggest bit of it, 60%. Well, they vary, sometimes a bit higher actually. So in reality, most of the world is invested mostly in the US. So if you're going to go do your own asset allocation, we call it, and with equities, and you're going to go, say, 70% UK equities, you're way off where most of the world is.
Right. Okay, and once you've allocated and picked classes and vehicles, the key question, when to buy and when to sell?
Yeah, there's no easy answer to this. The simple rule is cut your losses quickly, yeah, and run with your gains and your winners.
I've read, isn't it? Well, some like to say when 20%, when you hit 20% loss mark, that's the moment to get out of a position.
Yeah, that's a pretty
a
safe
sensible
rule.
kind of skim from the top.
Yeah. So usual kind of. I mean, look, there's no hard and
By the way,
fast.
I haven't done that. I've written it right down to.
And loads of us have all fallen foul of that, and that's how you learn, really.
Yeah.
There's no hard and fast rule, yeah, and it depends on the type of investor you are, and it depends on your short-term horizon, long-term horizon, blah blah blah. Lots of factors come into it. But by and large, if you cut your losses and you start looking at something when it gets down to a 20% loss, and maybe even if you don't sell all of it, sell most of it or half of it, or start selling a bit of it, as it starts going below 20. But 20 is not a bad rule for your losses. For your gains, everybody says run with your gains, but you've got to be ever so slightly careful of that, because if you do incredibly well on one thing, it can end up dominating your portfolio, yeah? And then suddenly you've found out you've got like one position, you're something like 40, 50, 60% of your portfolio because you do so incredibly well.
So overweight.
And you're overweight at that point. So although the advice is, run with your profits, I tend to disagree and say, actually, I would suggest once you get above 50% start looking at it, maybe take a little bit of profits. 100%, take a little bit more. 200%, take quite a bit more.
Okay.
And that way you're kind of top skimming all the time with your real good positions. And then it really does depend upon your own risk tolerances.
And what do you do with the good position
I
takeout?
personally...
Do you invest into your weaker positions?
No, because I go back into my main positions.
Okay.
I wouldn't reinvest in stuff that's already breezed past its 20% loss.
Okay, fine.
Because I would start ruthlessly weeding that kind of stock out or fund out, yeah? But let's just say, something's quadrupled and then all the other portfolio has gone up by 10 or 20%. Yes, I would then take some profits and then reallocate it to the other ones.
Got you. Okay. And that's something I'm going through a learning process at the moment of getting used to doing.
Yeah.
I think
it's very difficult because
that's
actually
me being the active investor in terms of keeping an eye, making decisions.
And actually, if you talk to many institutional investors and many academics actually study it, they're much more ruthless, and they say you should do what you call the equal weighting system, which is that basically as soon as anything starts getting much above a certain level, say 50% gain, top slice it and get everything back to an equal weight. So each of your stocks is the equal position in the portfolio, and ruthlessly apply that.
And do you think that is more of a short-term or long-term horizon strategy? That
I just think I think it makes a lot of sense, but unfortunately, I think behaviour is very difficult for investors to do because it just involves a lot more effort. You have to do a lot more trading, and frankly, people have got better things to do with their time. Actually, in index land and ETF land, an equal weight strategy. So let's say you take something like the S&P 500, an equal weight version of the S&P 500 consistently most times outperforms the ordinary version, which is what we call market cap weighted. So actually, equal weighting in an index is a brilliant idea. Absolutely brilliant idea. And talk to most academics and experts, they say equal weight all the time. Because the fund manager does it for you. Yeah, you don't have to worry about it, they do it, It's a brilliant idea. Not many people do it. They just buy an S&P 500 tracker or a FTSE 100 tracker, which is what we call market cap weighted. Actually, equal weighting makes quite a lot of sense.
Okay, very good answer, very detailed. I wanted to ask a question around big picture macro stuff.
Shoot,
I often see CPI data, GDP data, non-farmers payroll from the US occasionally comes up every calendar month. What does it all mean? And as an investor, a private investor, should we be taking note? Is there opportunities to follow this?
No, by and large, I would tend to avoid most of them. You should keep an eye on them. Okay. They're useful, and I'll tell you what I think is particularly useful at the present day is inflation measures. So the consumer price index, for instance, or people don't use the retail price index, RPI, much any longer. But you also see other variations of the inflation index. The inflation index is very relevant at the moment because it influences interest rates. So, and interest rates influence stock markets. So if you suddenly start whacking up interest rates, that's because the central bank wants to slow the economy down, wants a recession or slow down. That isn't very good for equities. So it is worth keeping a beady eye on inflation, because if inflation gets out of control, that usually means interest rates are going to get whacked up, which is bad for equities, and you might want to be a bit more cautious. On a lot of the non-farms payrolls, all this kind of stuff, for instance, that measures employment growth, how many new jobs have been taken on. Other people look at unemployment rates, and there's loads of other measures out there, there's a heap load of them. I think most private investors don't bother. It's just not worth it. Keep an eye on it, but I think beyond inflation and interest rates, I don't really think most of them should really affect your day-to-day practice.
And what's interesting on this is through the various forums and news channels and chats and catch-ups I keep following, February's been a bit of a difficult month for the equity market, even though it seems that these measures and pressures have eased. And in traditional terms, when the economic environment would ease up, stocks or the stock market tends to do quite well. There's questions that is it now turned the opposite? That as this stuff is easing up, actually equities aren't responding, stocks aren't responding on the whole.
I mean, and what you end up getting is, I think it's the tail wagging the dog, or the dog wagging the tail. It's should you be led by what is happening this month in this big picture data or not? And the only reason why it's important at the moment is because people are worried about interest rates. They're worried that interest rates are going to carry on going up, and that we're going to crash into a recession. In a sense, that's all that matters. And what's sort of spooking people out at the moment is that inflation, though it's coming down, is still quite high by comparison. Consumers are still spending all right, unemployment's very low, and people are worried that the central banks will keep whacking up interest rates. My argument from most people is don't bother. It's not worth worrying about it, because if you're investing over a 25, 35 year time frame,
it's just noise.
It's noise.
Yeah.
Okay, so given a long old 25 minutes, I have an investment idea.
Yes, you do, David. What is that investment idea this week?
Chrysalis Investments.
Tell me more.
It is a investment trust, so going back to our earlier one, but it's a venture capital investment trust. So what it does is it invests in private businesses, but what we call late stage private businesses. That's companies that are looking to list on the stock market at some point.
So well established.
Yeah. So big holdings, which everybody will have heard of, is Starling Bank, very big holding, very, very good online bank. And Klarna, buy now, pay later.
Yeah.
Two of their biggest holdings. And it's had a terrible time. Yeah.
Okay.
So the share price crashed. Yeah. And it had its own, how can we put this politely, kind of idiosyncrasies, that the fund managers got rather well paid in one year when the markets are doing well, and there was a bit of a stink about that. So it's had a terrible time, and one of the reasons it's also had a terrible time is because it's these late stage companies, the valuations matter on what these late stage companies are. And at one point, at the end of 21, it looked amazing, Klarna, shooting up, Starling doing incredibly well. And then as soon as you get in a recession or slow down, those valuations get kicked, and you basically have to start putting a haircut to all those valuations. And to their credit at Chrysalis, they have been much more upfront about slashing their valuations, and they've done a pretty good job, I think. And the board's got a good control on the manager now. Valuations are much better. They've slashed the valuations, and I think, if you look at its portfolio, it's got some fantastic businesses in there.
Fintech orientated, more so.
More fintech orientated, but it does have other.
lies.
But it does have other things. I think it's got Graphcore in there, which is semiconductor business, which is very good business. And it's been diversifying away from fintech. Everybody thinks it's fintech, but it's not purely fintech. And I think, personally, it's got a high quality portfolio of businesses that will do very well in the long term. And what you've got to be careful of is, if you look at the price now and then you look at what we call the value of all of its assets, and we call it net asset value, there's this massive discount. I'm not sure. Whenever you hear this, it will be something like 45, 55, 55, 60, whatever the percentage. I wouldn't take too much notice of that discount. And the reason for that is that there's always a lag between what the private markets put as a value on something in the public markets. And so I don't entirely trust what the private valuations are. I think Chrysalis are a lot closer to a more accurate number, but I still think it's probably a bit out. And you need to put a discount in there, because they're not going to be able to realise much value. There's not going to be many IPOs anytime soon. So take all of that with a pinch of salt. But I think Chrysalis, if you're a long-term investor, I think certainly once the price goes below 75p and then below 70p and even below 65p, is, I think, personally an interesting investment.
And what happens when these businesses list that they?
Well, hopefully then you'll make a big gain.
But
absolutely.
they stay within the fund, or do they?
Well, sometimes they usually offload them.
Yeah.
They usually offload a bunch of the shares. Okay. And then they take the cash and reinvest it in something else.
So there are cycle periods.
Absolutely. And the classic venture capital model is invest in the early stage, ride it through to the late stage, and then start taking some of the profits off the table, invest it in the early stage companies, and you start again. And that's what Chrysalis does. Another company called Molten Ventures does that as well. And for the long-term investor, because it's going to be a very volatile ride, but for the long-term investor on a 5 to 10 year horizon, I think Chris has got a quality portfolio of unlisted private investments, and I think it's at a sensible price.
Good idea.
Right, well, I've answered all your practical questions.
Answered all my practical questions. Pen to pad has burned. I've got everything noted.
And are you doing 20%?
No.
Sharp intake of breath.
No, not quite. Yes, not far off. But not there yet.
Okay. Well, we need to. I'm now, listener. You can't see this. I'm now basically ordering him to bring out his wallet and start putting more of those debit card payments.
Can you hear the coins dropping on the table?
Right. Anyway, we'll be back in a couple of weeks' time. Thanks very much.
Bye bye.